Hello, welcome to a new video from Das Family Office. Today we're taking a look at how the financial markets have developed in the first half of 2025, and more specifically in the second quarter. As always, I'm joined by Chris, Isheng, and Mario. Great to have you here.
Hello, hello, good evening.
Hi.
So before we jump into details, Mario, let's start with a quick recap. What happened so far this year? So the beginning of 2025 was quite good. Both stock and bond markets showed solid returns. But on April 2nd, the so-called Liberation Day, the announcement of new tariffs from Donald Trump caused a lot of uncertainty. Markets dropped sharply and volatility spiked. But the recovery came just as fast. Volatility is now back to normal levels, and major indices like the MSCI World and the S&P 500 index have even hit new highs. Bonds have also recovered very well, and many of our bond building blocks have delivered solid returns this year. But we already discussed it in our last monthly review. We seem to be in a kind of transition phase. Trump has only paused the new tariffs. They are postponed by 3 months, probably because of pressure from the markets. Although a lot of sectors recovered, some areas are still struggling. The US dollar has lost value against the euro, and sectors like healthcare and also mid-cap US stocks are underperforming. When we look at equity factors, well, momentum and value have done well so far, while the popular quality factor has lagged behind. So Mario, you already sent me the text for the quarterly review, and one term that you used quite often was the term taco. Maybe you can explain one more time what is the idea of this term and how can this term explain the development in the last quarter?
Yes, of course, Antonia. A taco is normally Mexican food, but in this case, we're not talking about Mexican food, but it's an abbreviation for Trump always chickens out, which is a term that was coined by a journalist of the Financial Times, and basically to describe that whenever the market doesn't respond well to Trump's policies, he has a tendency to quickly reverse his policies just to make sure that markets are being stabilized. I think it was very important to witness that on April 7th because there was this brief period between, let's say, the Liberation Day on April 2nd and the weekend where the financial community probably felt that Trump wasn't himself anymore, that Trump had converted himself to some dogmatic politician akin to what we see in Russia, akin to what we see in China. So politicians that really don't care about financial markets, that don't care about economic realities, but rather push a certain agenda, whether or not it can hurt the economy. And I think that surprised a lot of people. And I think that's also why we saw this sharp sell off on April 7th. And that's why it was good that he really chickened out on the 9th and effectively put the elevated or massively elevated tariffs on hold. And this has calmed markets actually to the point where all the losses have been recovered by now, more or less, except for US small and mid cap companies. And I think this is a big surprise because despite the fact that he's reversed, he did his taco movement, nothing has really been resolved. The tariff issue is unresolved. Yes, there is some agreement with UK, but that's also not a robust agreement. If you know that trade agreements sometimes take decades to agree to, it's highly unlikely that we're going to see a robust end to this discussion by July 8th, which is where this interim period ends. So I think we have to brace ourselves a little bit for volatility, and the markets may be a little bit ignorant at this point in time, especially buyers of the Nasdaq 100 or the S&P 500 market cap weighted at this current level seem to be overly optimistic because risk premiums are just between 3.5 to 4%. That means equity risk premium are lower than interest that you can collect on investment grade bonds in US dollar. I think people should use this environment to rebalance their portfolios. That's not to say that we would want to change our strategies altogether, but if somebody is heavily allocated towards these technology stocks, heavily allocated towards our quality managers with 70 plus percent US allocation, they should probably take a step back and put either fresh money into different investment ideas, or if there's no fresh money coming their way, diversify into Europe, diversify into Asia, diversify even into Latin America, and diversify into US small and mid cap stocks. Because, yes, they've been a big disappointment so far. They were expected to be Trump winners, but ultimately, Trump will be keen to help these industries, help small and medium sized companies. Current valuations are low. The US employment is holding up. Inflation appears to be contained despite the worries about the big, beautiful bill, which is widely deemed inflationary in nature. There seems to be room for the Fed to cut interest rates, maybe not massively, but a little bit, and this should help US small and medium sized companies, which typically have higher debt levels. Yeah, I would say use the current stability to review your portfolio. This is what we're doing with our clients. We highlight to them where valuations are maybe a bit excessive, where there's room to rebalance, and yeah, and reach out to us. We can help you to do that also.
By the way, when you're talking about rebalancing, what's the biggest mistake an investor can currently make?
I mean, the biggest mistake is not being invested. Some investors, they don't like to own equities. They don't trust financial markets. I can think of some clients who are still holding on to cash, which they've had for years and years and years. And it pains me to see that, because I know they could collect interest, they could collect dividends, they could see the price of good companies rise. So not investing, I think that's the biggest mistake, or not having a comprehensive, robust portfolio strategy. Just buying bits and pieces, some ideas here, some ideas there, and not putting it into a framework that reflects your personal situation, your cash flows. I think these are big mistakes, and these mistakes are made time and again, and on an ongoing basis. So please don't do that. It takes just maybe half a day per year to sit down, have a think about what a good portfolio could look like for you. Reach out to us. We can speed up this discussion. We can be your mentor. I think this could be a big mistake. And then the usual mistakes: overspend, spend too much for your investment products, buy investment products just because your banker suggests you do that, even if it doesn't make sense for you personally, and buying too expensive. I think people who keep on piling in into stuff that's been going up and has now reached massive overvaluations, and we see that in some of these popular tech stocks in the US. We see it in the Magnificent Seven. But to some degree, we even see it in the gold price. The current gold price reflects a lot of fear, a lot of uncertainty. I think it could be a mistake to keep on piling into gold, just and things just because they've gone up. It's never good to buy things just because they've gone up. It's good to buy things that have intrinsic value, that make sense, have currently attractive valuations, and then buy them and stick with them.
Then, talking about gold, Mario, Bitcoin is another, yeah, I call it currency, or yeah, another building block that a lot of people use to diversify their portfolio. What are your thoughts about Bitcoin?
Well, whoever knows me knows that I'm a big admirer of Warren Buffett, and Warren Buffett once said that it is quite weird how the world is behaving regarding gold. So you have people safeguarding other people to dig it out of the ground and then store it somewhere, and have more people safeguarding it again, and other than that, not doing much with it. And many people call Bitcoin digital gold. So if I already don't like the real gold, it's highly unlikely that I will like digital gold. At the same time, I cannot deny the fact that both gold and Bitcoin have done tremendously well, and some of our team members are big fans of cryptocurrencies and of gold. These are realities we need to accept, and I do accept. But they're also reflections of the current uncertainty in the world, right? The world is changing. The US is becoming more inward looking. We have an ongoing war in Ukraine. We've had military actions in Iran. If you had told me 10 years ago that the US would attack Iran, I think I'd have been very concerned at the time, fearing for another global war to break out. And we've seen that in the last couple of weeks. There's a lot of uncertainty. The world order is shifting, is changing. And I guess the rising gold price and the rising Bitcoin price is a reflection of that situation. So you could argue that if gold rises, if Bitcoin rises, it actually shows that the world is, yeah, is a more complicated and a less stable place than what we're used to. As per gold, we could argue that there's some analysis done by PIMCO and others who say that if you compare the current gold price to inflation adjusted government bonds, TIPS, you would probably arrive at a price between $1,800 and $2,000. So that means at current levels, we're witnessing a lot of fear in the price of gold. I'm not aware that anybody would come up with an intrinsic value of Bitcoin. Maybe you could argue the amount of money required to produce a Bitcoin could be a guidance, but it's going up. There are a lot of people who are looking to buy it, and as long as the group of people who are buying it is high, the price can go higher. We see that also in Tesla shares. Tesla also, as per most analysts, doesn't have much value, but there are a lot of investors who love Tesla and would probably buy it at any price just because they're such big admirers of Elon Musk. And that's also why short selling is so difficult. It's very hard to trade against emotions, trade against strong feelings, and trade against quasi religions. Yeah, we have to conclude it's certain things are going up even if there's no obvious value. The good news for me is, I would say, is that yes, gold has done very well compared to global stocks, and that is unexpected because research teaches us that the gold price should develop similar to inflation in the long run. And if Bitcoin is digital gold, it should normally follow that pattern, i.e., go up with inflation. But equities have worked, right? So we're big fans of globally diversified, high quality equity portfolios, and they have worked as well. So it's not really necessary to dabble with gold and Bitcoin. You can maintain your purchasing power if you build portfolios that combine stocks and bonds. But you can, of course, add it if you want to, right? And I wouldn't hold anybody back who says, I want to buy a bit of Bitcoin, I want to add gold. But in as much as the Magnificent Seven have gone up a lot, to me it feels like Bitcoin and gold have equally gone up a lot. So if I had the ambition to add it to my portfolio, I would probably hope for better prices. But if those better prices arrive, I would then also buy. So I guess if gold were to see a correction of yeah, I don't know, 30-40%, then I think one should add a little bit if one felt this should be part of a long-term strategic asset allocation. As per Bitcoin, I more or less look at it like currency, not because I think it's a currency, but we're basically looking at the charts, at the technical patterns. What are buyers and sellers doing? And if there are a lot of sellers, and we've seen that there has been a crypto winter, there are times when the group of faithful is getting a bit smaller or a little more or a little less sure, then maybe that's the right time to buy Bitcoin. What's interesting for me as an observation is that similar to how silver doesn't really perform as a second derivative of gold, these so-called alternative coins or altcoins are also not working. So it's really, I would recommend if anybody wants to dabble with these things, stick with gold, stick with Bitcoin, and ignore the rest.
Mario, the 30-year Treasury recently has hit 5% about 10 days ago, off the back of a lot of worries that the new Big Beautiful Bill will increase the US deficit by up to 3 trillion, which is the largest increase it's ever seen. Do you think there's any justification in the bond market to be worried about the US debt and the trajectory it's heading, seemingly that there's no party that's willing to correct costs on the deficit?
Yeah, Ishan, you're absolutely right, and a lot of actually all the bond gurus that we sort of observing that's Pimco. There's also a gentleman called Rick Reeder of BlackRock, one of the popular bond managers there. Or if we look at Jeffrey Gundlach of Double Line, they're all quite scared of the 30-year Treasury, and The news flow is really stay away from long duration bonds, stay away from the 30-year treasury. But what I've observed in the last several days is it's come off the 5%. We're now at 4.7% on the 30-year treasury, and we're just about 4.25 for the 10-year treasury. So I'm wondering who the buyers are. If all these big boys don't buy, if China supposedly wants to own gold instead of U.S. treasuries, then I'm wondering who the buyers are. I mean, that's not to say that the big beautiful bill is not inflationary, but the market at this moment is telling us that despite the big beautiful bill, inflation can be contained, or even the US is about to move into a recession. And that's why certain influential market participants are buying. Yeah? It'll be interesting to see when they stop buying. And yesterday, I've read on Bloomberg actually that Scott Besson was asked why he's not issuing more 30-year Treasury bills. He was basically, or the article was basically implying that Besson is treating the treasury like a hedge fund. And he was asked why don't you sell more 30-year treasuries? And he said this is something that should have been done in previous years when inflation was more contained. That's when it should have been done. Now it's too expensive. And I guess what he does is he compares the 30-year treasury yield to the tips market, to the break-even inflation rates, because the 30-year break-even inflation rate is at about 2.5%. So I guess he's suggesting that the market is overly negative on these, and he would issue more long dated bonds compared to short dated bonds if the pricing was better. So we will find out in the next couple of months who is right, whether the big beautiful bill will indeed be as inflationary, or whether we will witness a US recession and the need to, yeah, to rebalance portfolios away from expensive stocks into treasuries. It is a fact that the US debt is too high, and I guess everybody is wondering how this debt can be reduced. The best way to reduce debt is to spend less. And there are some initiatives by the various government agencies to save, to retrench people. But market action tells me maybe some of that fear is receding. I mean, 4.5% and Donald Trump as a president doesn't really get me excited for 30-year Treasury. So I would definitely also recommend to our clients to not go into these long duration bonds. There are other fixed income segments that are more interesting, that are cheaper, that are safer from my perspective. And of course, for long duration investments, we have quality equities. Actually, Rick Reeder, one of the BlackRock bond gurus, was suggesting that he likes US stocks better than 30-year treasuries. And maybe this is one reason, actually, that's what I feel personally. This could be one reason why we see the current US stock valuations. It could be that the market is saying, okay, if at any one point in time US debt will be restructured and we will not get $100 back, I still have the safety that if I have the S&P 500, that I own a fraction of these great companies. You know? Otherwise, it'll be really quite difficult to explain the current valuations of US stocks versus US bonds. But let's say from our perspective, we're international investors. We don't need to only stay in the US. I would even recommend for somebody who's really overly allocated in the US dollars to diversify. The US dollar is vulnerable. Other currencies are more stable, especially Asian currencies. So, yeah, I'm observing what's going on. I see traditional buyers being skeptical on the 30-year treasury, but I'm also seeing that some of these people may have changed their mind. And if I look at break even inflation rates, the market is telling me that I don't have to worry too much about inflation, even if the US may restructure their debt.
On the topic of US valuations, do you see this AI trend as a justification for the recent US valuations, or you think this is sort of part of the over excess that is froth in the market recently?
Yeah, I think the AI excitement is certainly part of the overvaluation. If I look at Nvidia or companies like Palantir, they're very expensive stocks. I mean, actually, Nvidia doesn't even look that expensive. But let's say if I look at Tesla, if I look at Palantir, or the crypto exchanges, there's a fair bit of froth in there. What we shouldn't forget is that companies like Google, Apple, Amazon, they can choose to yeah, build data centers slower or at a more measured pace, and buy fewer chips. Yeah, I mean, Nvidia has a comparatively small group of buyers at this moment that buy in volume. So it'd be easy for these companies to reduce investments, and that may hurt some of these AI players more so than the big names like Microsoft and Apple. But it's I mean, there's a lot of AI excitement. It reminds me a lot of the late 90s when we were excited about the internet. In those days, Cisco Systems was the company that supposedly could never fail. Now it's Nvidia that cannot fail. But I guess at some point, enough telecom companies had bought enough equipment from Cisco and they stopped doing it. Now we may be entering a period where the big boys maybe buy less Nvidia chips or buy them at a slower pace. So some of that froth will certainly disappear, but Nvidia is probably still one of the best ways to express that AI excitement. I wouldn't chase it at this point in time. There have always been situations where these great stocks dropped 30-40%, and that's a time to scoop them up. At this moment, there's a lot of skepticism towards Google. I mean, I'm not a stock picker, I'm not promoting our stock picking prowess, but Google stocks look comparatively cheap. So if anybody wants to stay with these great names, maybe you own Google more so than some of the other names. Apple also looks very expensive. I don't see the growth. I don't see the catalysts. So I'd probably prefer to own Google more so than Apple at this point in time.
Okay, so we have reached almost the end of this episode, but I have one last question. You already mentioned that the tariffs will come back in July. What do you think will be the impact on the financial markets? Do you think that we have a summer slowdown? Or do you think that we will have a lot of volatility, not only in July, but also afterwards, like August and so on? So, what is your expectation for the summer?
July is often a good month because companies are reporting earnings, but the real soft period kicks in August when a lot of the New York traders are in the Hamptons, frolicking with their families. Yeah, summer or especially August to the end of October is often associated with weaker markets, more volatile markets, because the big boys are supposedly by the beach, and the more junior stuff is manning the desks. And if some unpleasant news hits, they may not know what to do with it, and some securities will see sell offs. What I would say is, given the fact that markets have recovered the way they have, it's an important time to rebalance and look at some of these excessively valued U.S. large cap stocks. I think they're prone to corrections whenever valuations are very high, and here we're looking at risk premium of as little as 3.5 to 4%. Then corrections can happen because a lot of people are in the money. A lot of people are keen to take profits if certain bad news hits, or if the outlook darkens. Naturally, we don't know what's happening. Also, the summer period is normally a period within which there will be some profits, but typically less than in the first half of the year. But that's not a good enough argument to leave the market altogether. But the fact that we see currently high valuations in US large caps, the fact that July 8th is around the corner where this 90-day interim period is ending, people should brace themselves for a little bit of more volatility. And some of the great managers that we like, some of the quality managers that we like, have expensive portfolios now. So it may be a good time to take some chips off the table. You get nice interest rates in money market paper in US dollars and most currencies. So just rebalance a little bit and use softness if it happens to buy quality investments at a better price. At the same time, if we ignore the fact that these segments are overvalued. Europe is still comparatively cheap. Asia looks cheap. Latin America looks cheap. And I would also recommend revisiting the idea of the dollar. I mean, if you look at the DXY index, it's come off a lot. It came from 110 to what is now 97 points. But there was a time in the late 2000s when it was actually at 75. I'm not saying it'll drop there, but to me, it looks as if there could be significantly more downside to the dollar. And if somebody has a reference currency, which is maybe Singapore dollar, because we're in Singapore, or Korean won, or euro or sterling, you may not want to have too much money in US fixed interest investments. So relook at your portfolio also from the perspective of what the underlying investments you have. Even the recent recovery in the S&P 500 doesn't look so great in euro, doesn't look so great in Singapore dollars. So it's important to take that into consideration. So if this is just the beginning of an extended period of US dollar weakness, investment portfolios, especially of people who are spending euros, spending Singapore dollars, spending sterling, should probably be careful to not hold too much US dollar in their portfolios.
Okay, so last but not least, you can find the link to our latest quarterly review in the video description. And you can also find our contact details. So if you want, or if you have questions about any future investments, or if you want to check on your current portfolio, feel free to contact us. We're happy to help you.
Yeah, please reach out to us. We love doing portfolio reviews. We detect a lot of interesting things that we like to discuss with you. We like to be your partner for the long haul. We're very different in that we are fee-only advisors. We have no agenda to sell you anything. We're really keen to help you build a portfolio that meets your personality, is executed at the lowest possible cost, and works for you. Have a great summer.
Thank you.
Bye
Bye.
bye.